All right, when you look at the Bitcoin price right now, it looks bad at 62,000. But when you compare that to what's happening on global markets out there, it's actually not as bad as it looks. And that's what I'm going to show you today. Because what you can see on global markets is we're actually seeing a bit of a meltdown, right? It actually started off yesterday with SpaceX, when SpaceX did this reversal. Like, look at this big reversal that SpaceX did on the one-day chart. Now, the thing about this reversal is, yes, SpaceX went down 16%. The thing that I didn't realize is that when you take 16% of a $2.4 trillion market cap asset, that means that $400 billion of wealth was wiped out on SpaceX alone. Now, here's an interesting fact for you. Yes, it is $400 billion of wealth that was wiped out on SpaceX alone. When you translate that into how much Elon actually lost, and I went to ChatGPT and I said, how much of SpaceX does Elon actually still own? So Elon still actually owns between 42 and 43% of SpaceX, which means that he personally lost about $200 billion yesterday. Anyway, let's go back to the bloodbath. So SpaceX crashes yesterday, wipes out $400 billion of wealth on the markets. Probably the best place here is to go onto the stocks bubbles. You can see that SpaceX wiped out about $400 billion worth of wealth. Then this morning, when we woke up, the Korean markets were reacting. They were down 10% or 9.99%. And then they were shut off by what they call a circuit breaker, which is an automated trading circuit breaker, which stops trading when prices are going up and down too quickly. Now, I wouldn't be too panicked about the North Korean the South Korean index, North Korean. I don't know if they have an index, because it actually only brings us back to levels from the 27th of May. That's how quickly this index is actually going up. But that's what the bloodbath in Korea actually looked like. And then the same thing happened in Japan, and that's what the bloodbath in Japan actually looked like. Japan was down about 6.3%. So you had SpaceX down, you had Korea down, you had Japan down. Then you have the NASDAQ now. Look at the NASDAQ futures. They look like they're going to open down, or are they open? They are open now. Down 3% on the NASDAQ futures. And that is what the NASDAQ looks like. Let me just refresh that just to make sure we're getting the best view. Nvidia's down 3.11%. Google's down 4.9%. Amazon's down 5%. Apple's hardly down. And a lot of others are down. Tesla's down. Microsoft is down. And a whole lot of other things are down. Let's talk today about why these prices are down and whether Bitcoin can actually withstand this kind of correction in the stock market. Because I think we've all been waiting for this correction in the stock market. And I want to show you today why we are moving down so quickly and why we're actually getting into kind of dangerous territory when it comes to stock market. And of course, what the implications can be on crypto. So if that sounds good to you, and it does sound good to me, let's get the show on the road, guys. Lots to talk about today. It's a red bloody day on the markets, bloody day in crypto, bloody day on the stock market, as you can see over here. Bloody day on the stock markets, bloody day on crypto, bloody day on crypto. Yeah, and bloody day in Asia. So let's get the show on the road, guys. Guys, tell me in the comments how many of you are watching the Soccer World Cup. How many of you are quite immersed in it? I mean, look, I'm South African, so we've been watching South Africa play. They drew one and they lost one. Miracle that they drew the last one. They were playing so badly, but now there is one more chance for us to actually get through. I'm kind of keen to know how many of you are. There's a guy here from Sweden, GM from Sweden. Yeah, tell me if you guys are watching the World Cup. Tell me if you guys are taking bets in the World Cup. Tell me if who you guys are supporting in the World Cup. I've been messing around on Rain. I don't know if you guys know the platform, the Rain platform. It's a prediction market. I'm not going to spend any time talking about the Rain token, but I want to show you. I want to actually show you the platform. The platform looks something like this. It's a prediction market. It really has amazing odds and amazing liquidity on all the games, right? So you can basically go and take, I don't want to call it bets, you can take predictions on the game. You can go all the way up to the World Cup winner, which right now, the World Cup winner, 20% France, 14% Argentina, 14% Spain. So France still the favorites, which means Kylian Mbappe he's 26 years old. Can you believe that? I mean, Messi's playing well, but he's not 26. Kylian Mbappe is 26 years old. Anyway, if you want to take a trade, on Range, there's a link below. Go and check it out. If you are interested in prediction markets, I've been messing around with it. Actually, it's actually pretty cool. I'll be honest, really, really cool. Anyway, let's get into the action of today. And the action of today must be the bloodbath that's happening on global markets. I want to spend a little bit of time talking to you about why we're getting such a bloodbath on the markets today. And I think when I break it down for you, it'll make a lot more sense. Because certainly when I was researching the show, because how the system works here is we first see what is happening, what's going to happen in markets, and we do all the research during the day. And then obviously I come to you and I bring you a show. And in between that, we also write a newsletter at some point. There's a link below to the newsletter. So I want to show you what I actually uncovered, and I've actually been working on it for quite a while. This is not a new thesis. It's quite an old thesis. I've been following it for quite a while, but it's actually got to do with stocks and the markets for stocks, and specifically the markets for AI stocks being incredibly overheated, and that is causing some panic. And what happens when we get that panic is markets start to have sharp movements, right? So almost think about it like if markets start going down, and you've just let's say you put $1,000 into markets, and markets start going up. If the markets start shaking when you've got $1,000, you're not that scared because you've got the $1,000 in. When you go up and the 1,000 becomes 10,000, then you start banking on the $10,000. Then the markets start moving. Then you actually start getting shaken by the moves, and that's exactly what's happening in the markets, right? So let me show you what's going on. I think the start of the thesis is that you've got to look at world markets, and you've got to look at the patterns that world markets are actually putting in at the moment. This is the South Korean KOSPI, which is the South Korean index. And I mean, I'm more showing you this so that you get a view for the pattern. Just look at that pattern. Like, you want to talk about a parabolic move or an unnatural move. I mean, you can say that this market from April last year, which is just over a year away, is up 254%. That's a stock market. That's not a meme coin. It's a stock market. Now, granted, when you look at the South Korean market, the South Korean market is actually dominated by two assets or by two stocks, Samsung and Hynix. Now, keep this in mind while we're actually talking. And you can see that those two stocks make up $2 trillion of a $4 trillion market. And the next stock on the way down actually is about 10% the size of the top of either of the top two stocks, and 5% or 3% the size of the two of them combined. And this is one of the things that I want you to pay attention to. When you have a market where the majority of the market is concentrated in a few stocks, then something actually happens, and I'll show you what's actually happening. But I think the premise or the start of this thesis is we've got to look at world markets and say what's happening in world markets right now isn't natural. That's the KOSPI. Here's the Nikkei. Same view of the Japanese Nikkei. Same parabola in the Japanese Nikkei. Maybe not as aggressive in the Japanese Nikkei, but I think you'll agree with me that if you go back to stocks, I mean, in the history of stocks, you haven't seen a parabolic move like the one that we've currently seen now. Now, the markets, because of this parabolic move, all markets move exactly the same when it comes to parabolic moves, right? It's because markets are a mechanism that oscillate between fear and greed, and when you get to the top, you start getting the moves. You start getting the stories of a 26-year-old unemployed man who has bought $60,000 worth of Taiwanese stocks. He's borrowed money and he's advising others to borrow money to do the same thing. Why? Because markets only go up, and people bet on the fact that markets only go up. We know this because we're in crypto, which means that we know markets better than anyone in these stocks. And we also know kind of like what happens when these markets actually, we know what happens at the end of this. We know that there's some kind of correction at some point, right? And so that's where we are in the markets. We're at a point now where global markets are extremely overheated. And just follow my thesis here, because everyone's talking about overheated markets, but I actually want to break it down for you a little bit more. So right now we're in the FOMO stage, right? We're in the FOMO really got me. We're in the FOMO stage of markets. This is where when markets oscillate between extreme fear and extreme greed, we're now going into extreme greed. Extreme greed creates irrationality. I mean, this is probably the equivalent of us thinking that meme coins were going to be culture. Remember that's really where stock markets are at the moment, right? To make it worse, if you look at the markets are being driven by a couple of sectors. 𝗙𝗃𝗓 says the markets here are being driven by two sectors. I don't really think it's two sectors, but he breaks down. He says the S&P 500 has added $5 trillion in market cap so far in 2026. Okay. Meanwhile, the AI stocks have added $6 trillion in value, followed by $2 billion in value by the energy sector. So it's driven primarily by AI, and I'm going to call it AI and related because it's AI and infrastructure or energy that is related to AI. So ultimately, this trade is being driven by one thing. which is effectively AI. Now, again, break down the math here. The S&P's added $6 trillion in value. However, the $5 trillion, sorry, the S&P's added $5 trillion in value, but $6 trillion has been added by AI, which means that the others have actually lost value. So it says at the same time, other sectors have erased $1 trillion of value. And that kind of gives you two things. The first thing that's giving you is that the other sectors are not performing at all. And you can see that when you look at this chart over here. You can see that the other sectors, which are the blue sectors over here, are really not performing. And all the performance is coming from the orange sector, which is the S&P, which actually includes AI. And that's what's basically happening. The returns are being generated by AI. And as AI generates returns, more money flows out of assets like Bitcoin, like other assets, and flows into the AI trade. And that's basically what's happening. That's not the scary part, because heated markets are not always unhealthy markets. I mean, at least not in the beginning of the heated markets. Eventually, markets overheat and they crash because, as I explained to you, markets oscillate between extreme greed and extreme fear. Right now, we're going towards extreme greed. We know what the next moves are. Every time in history that it's happened, we then go back to extreme fear. So you've got the returns coming from the AI revolution, and you can see it in multiple things. Jim Bianco points out correctly so that since the war began in February, the S&P is up 8.03%. However, if you remove the AI stocks from the S&P is only up 1.04%. So you're starting to see a pattern. Between June 2 and June 10, the S&P corrected 4.5%. The S&P without AI actually went up. So what are we seeing here? We're seeing that the entire market right now is being driven by AI. So we know that. And what we're seeing here is that money is flowing out of every other trade towards AI. Dangerous. Why is that dangerous? Because if money is flowing from all the other stocks or all the other assets into AI, and then AI collapses, what happens? What happens? Well, that's exactly what happens. You wipe out wealth. So it's almost, think about it like this, right? Everyone is now FOMOing into the AI trade. They're taking their money off other trades, which are maybe slightly better, less crowded trades, and they're going into the AI trade. They're FOMOing into the AI trade. And I'll show you exactly how hard they are FOMOing into the AI trade. And the problem is that when everybody FOMOs into the AI trade, that's good. It makes them feel rich on paper for a while. But then when the AI trade collapses, and it will collapse, even if it's just a short-term collapse. Don't get me wrong. I really believe in AI and how AI is going to change the world. And I really believe that the technology is a great technology. But I also want to show you something, if this chart will take me back to that. Sometimes you have the right trade, but if you get into the right trade and you get into the right trade at the wrong time, I actually want to show you what can happen here. I'm going to go into 12-month chart of a NASDAQ. And I want to show you what happens if you got into the NASDAQ over here, which was the top of 2000. You got into the right trade because you got into the internet trade. Yeah, let me move it across. You got into the internet trade. Let me do it on a 6-month period because I think that maybe explains it a little bit better. So this is the 6-month trade. And what you'll see is that if you got into the correct trade, because the dot-com bubble was around the internet and the correct trade. However, if you got in at the wrong time, in this case, it took you 20 years. So you see that the top here was in January 2000 and you only broke even in 2016. And that also extends to individual stocks. So if you look at individual stocks, this is Cisco. I hope this chart. So this is 2000. Now look at when Cisco is a great company, right? However, if you got it in at the wrong time, it took you 20 years to make your money back. Even more, 25 years to make your money back. Right? And that just shows you that even though AI may be the best trade, if you get into the AI trade at the wrong time, you may have to wait a couple of years, maybe 10 years, maybe 15 years to actually make your money back. So that's what's currently happening. Everyone's FOMOing into the AI trade, and all the returns are basically coming from the AI trade. Now, here's the problem. As more money flows into the AI trades, the AI stocks get bigger and the other stocks get smaller relative to it. You can see it here on this chart, like Nvidia, Alphabet, Apple, they all getting bigger, but all the other stocks are actually getting smaller, right? You can see the same thing when you look at South Korea. So you look at South Korea and you say, look at what has happened here. You've got Samsung and SK Hynix making up 50% of the entire market cap. And these are growing every day. So basically what you can say that the South Korean market is basically a combination of these two stocks. And really nothing else actually happens. I wonder if this one actually allows you to go back in time. Because then I can show you how this was a year ago, 2 years ago. And you'll see that it didn't look like this. And so what I'm trying to show you is that as the AI stocks run, more and more money flows into AI stocks. They get bigger and bigger. And as they get bigger and bigger, we get this thing called concentration risk at the top, right? So now you can see that 45% of the S&P 500 is made up of the top 10 stocks, which are AI stocks, okay? And what we know is that every single time that that's happened in history, it's caused a crash. And I'm going to explain to you why it's caused the crash, because this is the part that you need to understand. So you can see that that happened over here. Right now we're at 40% in the S&P 500, but it happened here in the dot-com crash, and then we collapsed. And then it happened here in the 1988 crash, and then we collapsed. Why does that happen? Well, I'll explain to you very simply, right? Imagine that you have a well-diversified index, right? In other words, the top company is a pet care company, and the other one is a computer company, and the other one is a gold company, and you've got a diversified a top 10 companies in an index, right? Then the thing is that if the gold company reports bad earnings, it doesn't hit all the other companies in the top 10. However, if you look at where we are right now you've got AI companies which make up the top 10 companies, and those top 10 companies are giving us 40% of the returns. However, what happens if we get bad earnings or a bad report around AI? Not only one stock collapses, but then 10 stocks collapse, right? And so generally, just think about the cycle like this. When you have a rush into a specific narrative, people get excited about the narrative. Then the companies in the narrative grow and they make up most of the index. When they make up most of the index, most of the money goes into those companies. Because remember, if you're in the top 10 of the S&P 500 and you're in the top 10 in the NASDAQ, most of the index tracking funds have to put money into to continue to track the index. So now you have companies growing. The more they grow, the more indices they get included into, the more they grow. Therefore, the more concentrated the indices are. Therefore, the most concentrated all the money in the world is, because now it's all concentrated around these companies, because it's all a function of index tracking funds. And then one of them reports bad earnings, or we get a Chinese model that changes the landscape, or we get some kind of problem with AI. And then the problem is that it doesn't only hit one company, it hits 10 companies or 100 companies. And then that's when we get a correction. And so that's why every single time that we get this concentration risk amongst the top companies, it's a sign that we'll soon get a correction, because what happens is all the money flows into these companies, and then we get the one company reporting bad earnings, and it ripples down into all of them. So imagine now if ChatGPT, or I don't know, if NVIDIA reports bad earnings, then all of a sudden, or bad forecast, then all of a sudden all the other top 10 are basically going to get hit. And that's why this concentration risk is so scary. And it's so scary because the concentration risk is not only happening in the US, but it's actually happening everywhere in the world. It's happening in Taiwan, it's happening in Japan, it's happening in Korea. And so worldwide, we've got this concentration of stocks and a concentration of one narrative. One narrative is driving every single one of the global markets. Can you imagine how much concentration risk that is? And so if we get an AI shock, or if we get an AI surprise, then the problem is that we're going to get world markets collapsing all at once. And that's the problem here. And that's why people are starting to get nervous. And specifically, they're starting to get nervous about AI. How do I know this? Well, I know this because I'm an investor, but I also know this because I'm looking at data. And this is a specific data point that I'm looking at. If you look at the ratio between the NASDAQ 100 implied volatility and the S&P 500 implied volatility. So let's just understand what that means. The implied volatility means how scared people are in the NASDAQ versus how scared they are in the broader non-tech S&P 500. So the NASDAQ is a tech index, and the S&P 500 is a non-tech index. And so when you take the ratio between the volatility index for the tech index divided by the volatility index for the non-tech index, what you get is you get a ratio for how much more scared people are of tech versus non-tech, or AI versus non-AI. And this is what that chart actually looks like at the moment. I'll make it a bit bigger so that you guys can see it. You see the problem here. What people are telling you is that they are now getting really scared of the overcrowded AI trade, right? And probably rightfully so. The reason why they're getting so scared of the AI trade is because of this concentration risk. And if one AI stock sneezes, then we're gonna have a collapse of the house of cards. Not only in the United States, but we'll also have it in Korea, in Japan, in Taiwan. This is a global technology. This is a global phenomenon powering the world. We haven't seen very many of these revolutions. I think the last one was the .com one, where the whole world participated in one revolution, and that one revolution was driving the markets of every single country in the world. And so that's where we are right now. And within the revolution, there's a concentration in certain parts of the revolution. So one of them is energy. Like there's a concentration in energy because this AI thing revolves around energy. But then there's another one, and that's called semiconductors, right? Semiconductors underpin AI. So chips represent 95% of an AI server rack's value. So imagine, like, for all this computation, for all these, every time we have a revolution, and I'll show you that to you here, every time that we have a revolution, the thing that powers the revolution is technology or compute. And every time this happens, it increases our needs for semiconductors, for the little chips that actually, the computing chips in the computers, right? That's what you call a semiconductor. You can see it here in 2000, right? In 2000, we topped here because this was the top of the internet .com bubble. And what actually happened here? Well, we had the internet, everyone believing that the internet was going to be the best technology all the way up here, buying and pushing up the semiconductor prices because you need semiconductors and computing power to actually fulfill these revolutions. And then we got here where it became overheated, and then there was a crash. Now, scarily enough, that if you overlay the semis in the .com bubble with the semiconductor index here today, you can see that it's following the same pattern of a peak in a technology bubble, right? So the semiconductor index shows us it's a proxy for technology, or specifically computation in this kind of bubble. Now, you can see it over here. You can see that retail is now going crazy buying semiconductors. Semiconductors are the index for FOMO. They're the index for overheatedness in a market. Why? Because when you believe that a new technology is going to explode, so you believe that a new technology is going to explode, and then what you do is you invest in the picks and shovels behind it, which is the semiconductors, because you believe in that technology, and the semiconductors start to overheat. And that's effectively exactly what's going on here. You can see that this is the inflows into the semiconductor ETFs, right? You can see that people are now starting to concentrate around the semiconductor ETF. So that's what's happening in the market. You've got this concentration risk, and then within the concentration risk, you've got a concentration risk in the concentration risk. Are the viewers here? Because the numbers aren't going up, and I see the likes aren't going up, or maybe I just haven't reminded people to like.
Yeah, maybe we should do that.
If you are here, just smash the like button, because it looks like our gauge here has actually frozen. Has it frozen? The viewer count, is it frozen? Oh, my screen is frozen. Okay. On top of that, so we're having this insane demand and this insane concentration risk around AI. But at the same time, what you're getting is some of the AI assumptions being challenged. Like, let me give you one of the assumptions that is being challenged. The whole AI semiconductor and energy assumption is that there's going to be a demand for GPU rental. But this is what's actually happening in the real market when it comes to GPU rental. The requirements have dropped by 33%. So people are moving into reality. Also, people are using AI less, right? Or they're using the expensive AIs less. So there's less of a demand for the compute, right? Some companies have cut their spending costs. Some companies have actually gone into more Chinese models. So you've got weekly token consumption of Chinese AI models on OpenRouter has surged to 18.5 trillion tokens, 3 times more than the level of 6 trillion, which means that companies are moving to cheaper models. Microsoft is one of them, weighing whether to host a version of DeepSeek as an ultra low-cost AI service provider in China. So that's one of the things that could actually shake the market. So ultimately what you've got is you've got a concentration risk, and you've got a couple of things that could now shake the market. One of them is, maybe this AI trade is getting overheated. Another one of these things that's happening is that the reality of the war is actually starting to come back and bite us in the ass, right? So when I say that, we had the war, right? And the war increased oil prices increased inflation, and we were all expecting rate cuts, or investors were all expecting rate cuts. And what are we actually getting? We actually now have a 36.3% of a rate hike in the next meeting rather than a rate cut. That's what's happening. At the same time, because of the expectations of a rate cut, the 𝗙𝗃𝗍 has broken above this long-time consolidation level. So if you look at the consolidation level over here, that's the consolidation level. We've been consolidating for over a year, and then finally we broke above this level over here, or this level over here, and now we've got the 𝗙𝗃𝗍, or the dollar index, actually rallying. Why? Because they are expecting rate hikes in the US. And so now the dollar is starting to move up, which is very similar to Trump's last, like this is the last Trump inauguration. You can see Trump inauguration here, then we come down, then we basically start climbing up again, and we actually get a stronger dollar. At the same time, the yield curve has started to invert. Now, for those, I don't want to get too technical about yield curve inversion. You'll hear this term quite a bit. What it means is it means that the lending rates for a 2-year government bond start to be higher than the lending rates for a 10-year government bond, which means that in the short term, investors are expecting some problems with the government, and therefore they don't want to lend to the governments. So one of the realities around this thing is that we may actually get rate hikes instead of rate cuts. I doubt it's going to happen, but that's what the market's pricing in at the moment. The other thing is that investors are starting to look at the markets and say, look, these markets are overvalued. These markets don't show value anymore, right? And you can see it over here, right? This is a chart that shows what the S&P implied multiple is and what the subsequent annualized total returns are afterwards, right? So this is the S&P 500's forward PE ratios and the subsequent returns. When the PE ratios go up, and this is where we are now, we're at 23, then the subsequent total annualized returns for the next 10 years become low. In other words, investors are saying, look, it's actually not worth investing in these markets, right? Because the annualized 10-year returns are not really that good. So basically, it means that markets are overvalued. And if you're buying in at these values now, you probably won't land up making money going forward. You probably just won't land up making money going forward, right? And so that's what people are seeing in the markets. One of the big sources that have seen this is the Bank of America. They publish a metric of how overvalued the market is. And what you can see on most their metrics, I'll show you this over here. Most their metrics, the market is above or below average. In other words, in scary territory. So you can see here that the market is above scary territory on all these metrics that they've got. And so right now people are looking at the market and going, wow, on so many of these metrics, the market is completely overheated, right? And so people are really starting to worry that if you invest in the market now, you basically won't get returns. And so that can slow capital going into the markets. And if capital slows into the markets slow down, and then the cascade actually begins. I want to play you this clip from Paul Tudor Jones, because I think the way that he lays it out is so clear.
We're clearly so leveraged in equities in this country. We're so dependent upon firm equity prices at this point in time. And when I say leveraged, we're 252% of stock market cap to GDP. So 1929, we were, I think at the top, we were 65%.
A lot of leverage.
In 87, we got to about 85 or 90%. In 2000, we got to 170%. And now we're at 252. So you can just imagine.
So notice what he's talking about. He's talking about the leverage in the market. We're more leveraged than we've ever been in the market.
Significant bear markets. Since 1970, we get kind of a mean reversion about, on average, every 10 years. When I say mean reversion, let's say mean revert to the past 25 or 30 year PE. So if we did that here, that would be, and again, these are elevated PEs, way elevated beyond the 20th century. That would be say a 35% decline. Well, 35% on 250% of GDP is 90% of GDP, the reverse wealth effect. Oh my gosh, 10% of our tax revenues or capital gains, they go to zero. So you can see the budget deficit.
So basically saying that this is a very bad time to be getting into markets because, on a relative basis, we're the most overvalued that we've been in an extremely long time. And so that's the whole thesis here. The whole thesis here is we're getting to the top of a market cycle. Now, I don't think this is going to be the big crash. I just think that when markets get overheated, you can see that markets get overheated. One of the big signs of a market getting overheated is that you get big moves at the top. And the reason why you get big moves at the top is because you've got all this pent up energy. And remember, energy is, in this case, fear and greed. So on the one hand, you fear because you don't want to be FOMO'd out. On the other hand, greed because you don't want to be FOMO'd out. But then you've got fear that if the market does move down, you panic and the moves actually become much bigger and much more pronounced. That's how you can tell, or one of the ways that you can tell a market top. And when you look at a market like the Kospi, I mean, just look at these daily candles. Just look at like what's going on in the daily candles. That is indicative of you could say a short-term market top. Now, could we still have another long way up? Yeah, we could. Could we get a 30% correction? Yeah, we could. Could get a 10% correction. What I'm trying to show you is, I'm trying to show you the data. I'm trying to show you the facts. I can't predict when this thing is going to change, or when it's going to crash. What I can show is I can just show you the broad picture, and then ultimately it becomes a game of you versus the market. In other words, how long the markets can fool the equilibrium for. And that's pretty much what I wanted to highlight to you today. So let me know if you understand it a bit better. Let me know if this added value to you. If it did, please give us a like. If you're not subscribed to the channel, subscribe to the channel. What else do we have for you? What else do we have for you in store today? In terms of the war, I keep saying to you guys, I can't really add much value to you on the war. There's a lot going on. Ultimately, it's all automated at 247 Newswire, it's the fastest newswire in the world at the moment, right? It's free, it's on Twitter, it's the fastest. Right now, it's only covering certain events like strategy and Iran and stuff like that, but it's going to keep covering more events. And I think when it comes to this, it's not an opinion account. We're not giving you any opinions. It's a newswire which actually scrapes from news sources. And the main thing is that it's the fastest newswire in the world. You can see how much faster it was than even like some of the big reputable newswires were. So if you want to follow that account, it's a free account. It's a free account here, 247 Wire. Also, I did speak to you guys about Rain. They are one of our sponsors. I have been playing in the prediction market with them. They did a deal with Mike Tyson.
Rain Trade is the only prediction market that lets you trade on whatever anyone can think of. So I came up with a market that moves me. Longest post-gold celebration.
I wonder how. So that's one of the markets, the longest post-gold celebration. I wonder how much they pay Mike Tyson. What Mike Tyson actually commands today. Imagine how the numbers have changed. I think that is it for today. I believe that is it for today. I will see you guys again tomorrow. Hopefully, tonight there's games. There's Portugal playing tonight. My kids are so excited about Portugal tonight. So I'm going to go watch Ronaldo play today. Hopefully, he can perform better than he performed in the last game. See you guys again tomorrow. Until then, trade well, my friends.